Hi, this is KW, the blue collar worker, back at it with a new video. This video is about the pitfalls of having a mortgage. You heard me, the pitfalls of having a mortgage. And I know the housing market is tight right now. People are scrambling to try to get anything they can get. And the first thing they need to get anything is pre-approved and getting a mortgage. Sounds easy enough, right? However, nowadays, they really scrutinize when it comes down to lending money to get a house. So, what are some of the things that you probably need to get started getting a mortgage? Well, first, you need good credit. Secondly, you need to have your documents in order, like your W 2s, information about your job, your taxes, things like that, because they will ask for it. You have someone from the bank that puts the package together. So she's going to ask you for your W 2s, 2 years of bank statements, and, this and that. And then once you get past all that, and that could be a little frustrating, but you'll get past it if you have all your documents in order before you even talk to him or her. And then secondly, you will then be passed on to the underwriter. And then the underwriter, they're going to ask you some questions as well. And then, if you get through all of that, then you get your mortgage. Now, once you get that mortgage, you probably say, well, I'm all good now, right? Well, technically you are. Congratulations, you got your mortgage approved. Now you can go buy the house of your dreams and live happily ever after, right? Well, here's some things that you might want to look at before start taking that fantasy dream of paying off your mortgage. Number one, the bank don't want you to really pay off that mortgage. They want to continue making money off you. So what do they give most people? Most people get a 30-year mortgage, and they pay it religiously for 30 years. Now, within that 30 years, once you get like 5 to 10 good years in a solid paying, right? Now you kind of getting somewhere. And the first thing they're going to do is send you out a letter saying, hey, how would you like to refinance your mortgage at a lower rate? And even take out some money to build that debt, take a vacation, buy that new car, or whatever. Now, you probably really don't need the money, but if they waving it in your face, sure, why not? Why not take about another 30, 40,000 out, depending on what your equity is in your property. So after, let's say, 10 years, you should have probably built up somewhat of equity. So you take out money, and then guess what? When it's all said and done, they reset the clock on your mortgage. Now you starting all over again. You might have had 10 years in. Now you starting all over again with 30 years. Secondly, you're going to be paying more money because you refinanced, but then you took out money, which is going to do what? Make the mortgage a little higher. So now, yeah, you got a better interest rate, but if you took out money, now you got a bigger mortgage. And even if you didn't take out money, banks generally charge anywhere from $3,000 to $4,000 to do a refinance. Now, if you're thinking about holding on to that property long term, sure, that can work. But if you're thinking about selling that property, say 3, 4 years down the road, you may want to think about it and just pay extra towards the mortgage, which is what I did. Because I'm gonna give you an example. Let's say you started out with, let's say, $100,000, and you were lucky enough to get your mortgage down to, let's say, 85,000. So you're actually moving pretty good. and they send you a letter out saying, why don't you just refinance your mortgage? And the interest rate looks good, so you do it. So now they tack on to that $85,000 that you had. Now you got $89,000 again. You almost back up to $90,000. So, that's something to consider when you're thinking about, refinancing your mortgage. I've owned several properties throughout my life, and at one time, I was using my mortgages as a cash station. I was cashing out, but what happened in the end? I had a lot of big mortgages. So that's something you want to consider. And here's another thing you might want to take under consideration. Let's say you're a senior, right? And you decide that you get one of those letters and they tell you that you can get some money because you probably have a lot of equity built up into your property or your house is paid for. So what happens? You take out a loan, you're on fixed income as a senior. Now, if you didn't have a mortgage, congratulations, you got a mortgage again. And what you should really look at is, can you afford to have that mortgage in retirement? Because in retirement, you generally on fixed income. So can you really afford to have a mortgage and you only got X amount of dollars coming in? I've seen a lot of seniors lose their properties like that because they take out these loans and really can't pay it back. So is it the bank fault or is the senior fault? Well, it's the senior fault because you should never take out something that you can't afford. And here's another scenario. Let's say you want to, pay off your mortgage sooner rather than later. Because here's the thing. Most people take out a 30-year mortgage and they just pay it religiously for 30 years. Did you know that you can pay your mortgage off within 10 years, 15 years, 20 years? You don't have to go by 30 years, here's 30 years, and you pay interest for 30 years. You literally buying that house twice. But if you paid a little extra towards your mortgage every month or get a part-time job and you were able to pay more at it, you're going to get that mortgage paid off a lot sooner, a lot faster, everything. Now, should you pour all that money extra that you're making into the mortgage just to watch those numbers come down? It depends. Now, let's look at two scenarios. Now, you can, pump a lot of money into the principal and watch your numbers come down and be happy about that. You really doing good. What if you get in trouble? What if you lose your job? What if you get laid off? Will that mortgage company give you back some of that money you was paying towards the principal? No, you don't get that back. Will you be able to borrow from the bank to bail yourself out? Probably not, because you're in trouble now. So the bank is not going to give you any more money. If anything, they're probably thinking about how we going to get this house back. So those are things to consider. So what should you do? In my case, what I did was I paid a little extra towards the mortgage, and then I put money in the bank, or I put money in some type of investment and let the money grow over time. And then when I was ready to cash out, then all I did was either take the money out of the savings account or take the money out of investment and then pay it off. Because if you put the money all into the mortgage company, good luck. You're not getting that back. But if you took that same money and you put it in an investment and your investment is doing good, you're going to be making money, and then you also can tap into that money if you fall on hard times. So which would you do? Would you give it to the bank And then you got to go through all them trials and tribulations and filling out all these documents and everything just to be turned down, because if you're on shaky ground, the bank isn't lending you any money. But if you took that money and you put it in the bank, well, now you can just tap it. Or if you put it in an investment, you can tap it and possibly bail yourself out or buy yourself some time. So I would say do the latter of the two. Put the money in the bank, put it in an investment, and pay a little extra towards the principal. And then when you're ready to cash out on that mortgage, then you bring all the monies back together and then cash out. That's what I would do, because I've been there. And, and the mortgage company gonna just say, hey, sorry, can't help you. So, don't put all your eggs in one basket. And the next thing, when you're dealing with a mortgage, it's better if you can get your mortgage as soon as possible. I see a lot of young people want to wait. Why you want to wait? Let's say if you're 25, you got a decent paying job, and you're already renting an apartment, right? Why not just buy yourself a house? So if you're 25 and you took out a 15-year mortgage, which would be hard, your house would be paid off at 40. Or you don't even have to do that. You can take out a 30-year mortgage, but pay it back like it's a 15 or 20-year mortgage, and you'll pay it off a lot sooner. Or you could do the bi-weekly. You have to pay one whole mortgage up front, but after that, they take out half of it every 2 weeks. And what you do is what I did was, try to have at least 1 month's worth of mortgage up front. So this way, when that starts, you're already ahead of the game, and then you can just the money will be there in the bank for them to pull. And let's say if it starts in January, right? And you got an extra mortgage up there. Okay, so the bank is going to pull that January, but you're already with your paycheck working on February in January. So when February rolls around, you already got that money. So you're always like a month ahead. So you're not getting in trouble, but you got to be disciplined doing that and not use the money for something else. So if you did those things, yeah, you can pay off your mortgage sooner rather than later. And like I say, a lot of people tell you, oh, well, if the interest rate is low on the mortgage, I would just keep the mortgage and then, invest in whatever. I'm a strong believer that if I can pay off my shelter first, I'd rather pay off my shelter first. I mean, that's me. I know all the experts and talking heads tell you, oh, keep the mortgage because you can get a write-off on it, and it's got a low interest rate, and blah, blah, and blah, blah. But if I can pay off my mortgage, if I get laid off, I can buy myself some time. Because it's easy to pay the county taxes and the insurance. But that mortgage company, if you got a decent house in a decent area, 3 months, they foreclosing. They ain't trying to hear it. And if you pumped all your money into the mortgage, paying it down, let's say if you've been paying, watching that mortgage drop, but then you fall on hard times. Now, that man got all that equity, and they don't care. All they want is what you owe them. So if somebody come behind you and buy your house from the bank, they're gonna be the ones with all that equity. So like I say, if you can do it like that, that's good. But I would say put part of that money that you pay extra to the bank in either some type of savings account or some type of investment account. And then this way, if you get on hard times, you can tap that money to possibly save your house. So that's all I have on the pitfalls of having a mortgage. Again, this is KW, the blue collar worker, back at it with a new video. Take care, guys.